Good afternoon, everyone. Welcome to Nova 401k Associates webinar on plan design features to consider for 2022. Today's webinar is eligible for Texas CPA credit and ASPA CE. Right after the webinar ends, you will see the survey pop up if you are needing either of these credits, so please complete that survey. We have also added the slides as a handout. Just click the handout dropdown on your GoToWebinar panel, and you can download and save to your local folder. Today's presentation will be presented by Team Leader Jason Worms and Senior Account Manager Carrie Teague. If you have any questions, please type them in the questions box and we will go over them at the end of the presentation. And if you can, please include the slide number it pertains to. I will now hand it over to Carrie.
Thank you, Jasmine. Thanks for joining, everyone. We're going to discuss plan design configuration considerations for 2022. My slide is not advancing. There we go. Okay, we have to get our housekeeping items out of the way first and just have a standard disclaimer. This is essentially just general in nature, although we do know what we're talking about. It's not intended to be a substitute for legal advice or tax advice. If you do need that type of advice, we suggest that you consult with a professional, such as an ERISA attorney or an accountant. As Jasmine mentioned, if you need Texas CPA credit, the information will pop up at the end. Here's our provider number. You have to register individually. You do have to be present for the entire webinar, which, given the amount of content, should probably last at least the full hour. And now let's get right into it. High-level agenda, really these are the things not necessarily in this order, but the things that we're going to cover. Why would you consider plan design changes to your 401k plan? We'll look at what the current limits are for contributions and then dive into various possibilities for plan design considerations and changes that you might like to make. And then if you would like to move forward with some of these considerations, what the plan amendment requirements are to put them in place. And then as Jasmine said, at the end of the presentation, we will address all the questions that have been submitted throughout the presentation. So our objectives are to look at why you might want to make changes in a qualified plan, why it's a good idea to even ask yourself those questions or consider making changes. Then, like I said, look at various considerations of things that you might want to change. Not necessarily suggesting that any of these have to be changed, but just, thought process and food for thought. And then, like I said, we'll look at the process for how you go about making those changes, how you go about implementing them, any additional requirements that are necessary to your plan document in terms of an amendment. So why change? Why even think about changing? It's kind of a good idea, really. Periodically, some people feel like annually is a good time frame to revisit your 401k plan design. Depending upon how long the plan's been in place, your intent and the objectives for the plan may have been one thing 5 to 10 years ago. Business has changed. The objectives might be different. Your demographics have changed. So it may be a good time, if you haven't done it in a while, to take a look at your overall plan design and whether it is meeting your current objectives. The state of the economy. It's kind of an understatement to say that 2020 and 2021, to a large degree, have been very challenging years. A lot of industries have fared worse. Some have fared better, but that's going to have an impact on your plan. And for example, if it was necessary last year because of business considerations to cut back, for example, an employer contribution or do away with it altogether, and business is on the uptick now, and you feel like you can revisit that again and maybe reinstate or increase a contribution, that's something that you could look at now. There have been some regulatory changes that might encourage you to make some plan changes. Your record keeper, your vendor, may have put some automations in place that may make certain changes easier to administer than they have been in the past. Recruiting and retaining top talent, that is something that a lot of industries struggle with. You may have, for example, and we'll get into these specifics later, you may have eligibility constraints that keep people out of the plan, and you're trying to get new employees on board, and you have talent that you're trying to attract. And one of the things that's important to them is participating in the 401k plan. So, and then also you may have employees requesting changes. If you have somebody that's come from another employer, excuse me, and for example, they had Roth deferrals available in their plan, but your plan doesn't. You may have employees asking for plan changes. So let's look at the current limit, and this is current for 2021. 401k deferrals, and that includes pre-tax and Roth. The limit for an employee who is under age 50 is $19,500. If the employee's age 50 or over, then they can kick in an additional $6,500 for a total of $25,000 in their deferrals. Compensation, the IRS limits total gross compensation that can be considered for qualified plan benefit purposes. So essentially that means that if you're allocating an employer contribution of 4% of compensation, the maximum compensation that can be considered is $290,000. The 415 annual additions limit speaks to the total contributions that can be contributed by and on behalf of an employee. So that includes employee and employer contributions. That is $58,000 plus an additional $6,500 in catch-up if the employee is age 50 or older. And in terms of the indexed limits for the upcoming year, they're typically released in the October-November timeframe. So, within a couple of months, we'll know what these numbers look like for 2022. Okay, so let's look at some of the features that you might want to consider changing. One is eligibility. What are the requirements to be eligible to participate in your plan? So changing eligibility, you could have traditional statutory eligibility, which is age 21 and a year of service, usually defined as 1,000 hours worked in a 12-month period. That could be unattractive to some employers if you're trying to get additional talent, you're trying to attract additional employees. So what you want to get is these employees into the plan. From a non-discrimination testing standpoint, it could help to bring additional employees into the plan if they're going to participate. And overall, what we need to remember is that the IRS intends for 401k plans to be a retirement savings vehicle. So what you want is to get employees into the plan and saving for retirement so that they can afford to retire. Now, there's a flip side to everything. If you make eligibility less stringent, so you're letting more people into the plan, and you have an employer match or profit sharing, then those costs will increase depending upon the number of people that elect to participate in the plan. So really, when you're looking at eligibility, and again, with a lot of these features that we're going to look at, there are pros and cons. So it's important when you're going through the analysis, and it's certainly something that we can help with, is to weigh the overall benefits of making the change against the overall costs associated with that change. One possible way to kind of skirt around or manage the increased cost related to having more or less stringent eligibility is to have what we refer to as dual eligibility. So it is possible to have a less of a service requirement on 401k deferrals, so employees can get into the plan and start making contributions earlier, and then still have a little bit longer eligibility with respect to employer contributions. A lot of companies like to do that to sort of weed out turnover, for example, in the first year. They're fine with employees joining the plan and deferring on their own, but would like to or would prefer to benefit those employees who are going to stay around for a while from an employer contribution standpoint. The only caveat here really is if you have a safe harbor plan, and we'll talk about what that means a little bit later on in the presentation, and your plan is top heavy, then if you have dual eligibility, that sort of it invalidates the top heavy minimum requirement. So you will not be able to rely on just the safe harbor contribution to satisfy your top heavy minimum requirement if your eligibility for that safe harbor contribution is different than the deferral eligibility. Okay, one of the other things, and we're kind of switching gears away from, I was referring to a safe harbor plan. If your plan is not a safe harbor and it is subject to traditional non-discrimination testing, and I'll try very hard to not use too much jargon on this slide, that testing is typically referred to as ADP, or average deferral percentage testing, and then down at the bottom, ACP, average contribution percentage testing. Essentially, at a high level, that test really just compares the average rate of contributions that highly compensated employees make against the average rate of contributions that non-highly compensated employees make. If your plan is subject to non-discrimination testing of this type, then your plan document specifies the testing methodology that must be used with respect to your plan. And there are two options. There is prior year testing and current year testing. So if your plan, for example, uses the prior year testing methodology, and we're getting ready to do non-discrimination testing for the 2021 plan year, we calculate the highly compensated employee average looking at their contributions for 2021, but we compare that average to the non-highly compensated employee deferral percentage calculated based on their 2020 activity. In contrast, current year testing, you don't look back at 2020 at all. If we're doing 2021 testing, we compare the average for highly compensated employees for 2021 to the average for non-highly compensated employees for 2021. And the mechanics of the average contribution percentage test is the same, but for employer contributions. So if that test is failed, and if those of you out there who do have a plan that's subject to this type of testing and you have been through a test failure, you know that typically the way that the test is corrected is by refunding excesses to highly compensated employees, and those refunds are taxable. So it's kind of an ongoing struggle for some plans that are subject to non-discrimination testing and have faced this over and over again, that the plan fails and has refunds to issue. One possible benefit to using prior year testing is that it's a good kind of planning tool, because you know going into the upcoming year what your highly compensated employee maximum is. You've already calculated it the prior year, so you know, hey, my highly compensated employees are capped at this much if I want to pass the test. You can potentially manage it by either capping highly compensated employees if your plan language allows for that, or encouraging highly compensated employees to elect a lower rate. The downside to that is that if, for example, you have a great year in terms of participation and you have a lot of non-highly compensated employees who've decided to join the plan, you don't get the impact of that increased participation with prior year testing until the following year. So there are pros and cons to both. It is possible to change your methodology. It does require a plan amendment because, as I said initially, it is specified. Your method is specified in your plan document. So if you want to change it, you do have to amend the plan. You can change it anytime. It just has to be done by the end of the plan year that you're testing for. So right now, if you want to change your testing methodology for 2021, it has to be done by December 31st of this year if you're a calendar year plan. It is always possible to change from from prior to current, But if you want to change from current to prior, that's fine as well, but the IRS restricts that you can only do that once in any 5-year period. So now let's look at kind of the opposite side of the spectrum, plans that aren't subject to non-discrimination testing of that type, safe harbor plans. It's a pretty familiar term, but I don't want to assume that it's, firsthand to everyone. The safe harbor plans were created quite a while ago in 1999. Typically, the impetus behind them has been plan sponsors that have had low participation among their non-highly compensated employees and have faced what I was just talking about, non-discrimination testing that's failed and highly compensated employee refunds and frustrated highly compensated employees, and highly compensated employees who have not been able to contribute up to the IRS maximum that we looked at on the earlier slide, the 19,500 plus 6,500 if possible. So there are certain set of criteria that have to be met in order for a plan to be considered a safe harbor. All of this is specified in the plan document. There are options, however, with respect to the employer contribution. There is a set employer contribution requirement for a safe harbor, but it can be fulfilled in 2 different ways. One of which is structured as a safe harbor non-elective contribution. All that means is that it is allocated to all participants who are eligible, regardless as to whether those employees decide to contribute on their own. So the minimum, if you're going to amend the plan to become a safe harbor and the employer contribution is going to be fulfilled through a non-elective contribution, the minimum rate is 3% of gross compensation to all eligible participants. In contrast to that, the plan can structure the employer contribution as a safe harbor match. So that would be allocated just to those participants who elect to defer on their own, to make contributions. And the minimum, which is typically referred to as the safe harbor basic match, is the formula we have listed here. It's 100% of participant deferrals up to 3% of their compensation, plus 50% of participant deferrals for the next 2% of their compensation. So if someone's contributing 5% of their own or on their own, then their safe harbor match would be 4% of compensation. So some employers, due to kind of the communication challenge in describing the safe harbor basic match formula, opt to go the enhanced match route and just sort of simplify that up to 100% of up to 4% of compensation, as opposed to the tiered formula. So a safe harbor plan has more than just the benefit of getting the plan sponsor out of the ADP and ACP non-discrimination testing, which is certainly probably the top benefit. So you avoid refunds for highly compensated employees at year end because you don't have that testing as a requirement any longer. Highly compensated employees, as I said before, can contribute up to the 401k deferral limit that the IRS sets. The top-heavy requirements, if your plan is top-heavy, and if no other employer contributions besides the safe harbor required contribution are made, then your plan is deemed to satisfy the top-heavy requirement, and there's no additional top-heavy minimum contribution that must be made. If you do, however, decide to make an additional contribution, for example, a new comparability profit sharing contribution, in addition to the required safe harbor contribution, then your safe harbor contribution could help, and it might satisfy the minimum gateway requirement for the non-discrimination testing that's inherent in that new comparability type of profit sharing allocation. So the other requirements and things to consider with respect to a safe harbor plan are, as I said, the employer contribution, whether it's structured as a non-elective or a match, is required. It's not something that you can decide, by the end of the year, oh, we don't want to make this, because once you amend the plan to become a safe harbor, that contribution is required. that contribution, the employer safe harbor contribution, cannot have any allocation criteria that have to be met to receive it. You can't have, once someone's eligible and they've met the eligibility criteria for that contribution, you can't then also layer on, oh, well, you have to work 1,000 hours or you have to be employed on the last day of the plan year, which is something that you see often in discretionary contributions. Safe harbor contributions are also fully vested at the time that they're made. So many discretionary matching contributions or discretionary employer contributions have a vesting schedule attached, that you have to have certain years of service to earn up to 100% of that contribution when you leave and take a distribution from the plan. Not the case with safe harbor contributions. They are fully vested when they're made. Now, there are some options with respect to if you want to make a change from a traditional plan to a safe harbor plan. If you want to make that change to be a safe harbor and you are going the non-elective contribution route where it's allocated to anyone who's eligible, you can do that within the given year, within the current year. So if you're seeing this presentation and you think that might be a great idea for us and you want to put it into place for the 2021 plan year, you can do that by the end of the year. Alternative, though, if you're, maybe don't want to do this, really are only interested in benefiting participants who are contributing on their own, and a safe harbor match would be a better option for your plan. That is only an amendment that can be made prospectively. So if that's something that appeals to you now and you're considering it, the earliest effective date is the first day of the 2022 plan year. There is also, we have a few, not very many, but there is something that's referred to as a safe harbor maybe plan, where the plan sponsor decides on a year-by-year basis whether they want to be a safe harbor, and that decision is made by the end of the year. There is a notice required that must be provided to participants saying, hey, this is what our plan looks like. We'll let you know later on in the year. If a plan is a safe harbor, there are restrictions that the IRS puts out that limit the type of plan features that can be amended during the year. So for example, if you want to amend, you're a safe harbor and you want to amend eligibility, unless you're doing something that's more generous, it's not something that can be amended during the year and would be a prospective amendment. So there were a couple of things, and we'll talk more, actually Jason will talk more later on in the presentation about some changes that were made as part of the Secure Act. But specifically with respect to safe harbor plans, the Secure Act changed some things about the annual notice requirement. So there's previously, prior to the Secure Act, there's a safe harbor notice that had to be distributed to all eligible participants in advance of the plan year to which it applied. So that requirement is eliminated if your plan is a safe harbor and the contribution is satisfied by a non-elective contribution. It is still required if your plan is a safe harbor and the employer contribution is structured as a safe harbor match. And as I mentioned on the previous slide, if you are a safe harbor maybe plan, then that notice is still required as well. And I mentioned a little while ago, if you do want to amend to be a safe harbor plan during the plan year, you have up until 30 days prior to the end of the plan year. If that's the case, then the safe harbor non-elective contribution is equal to 3% of compensation, but that's for the entire year. So for example, if you decide in November or October that you want to change the plan to a safe harbor, that does not mean that 3% only applies to compensation from the point that you make the change. It is retroactive for the entire year. There is also the ability after the end of the plan year. So if you get into February of 2022 and your testing is abysmal and you're subject to non-discrimination testing, run the test and you have horrible refunds and you would like to consider retroactively changing the plan to be a safe harbor for 2021, That is possible. It's just that the IRS requires a little bit higher contribution. So instead of that 3% of compensation, the requirement is 4% of compensation for the entire year. Okay, let's look at another possible plan feature that you may want to add. Honestly, the majority of plans that we work with do include Roth 401k deferrals, but for those that don't, let's take a minute and take a look at what they are. Roth 401k is, some people I think hear that Roth 401k and think that it's a separate plan. It's actually a feature within your 401k plan if you choose to add it. The ability to make deferrals on a Roth or after-tax basis was introduced in 2006, so it's been around for quite a while. And initially, really not a whole lot of traction, but it's kind of, like I said, become the norm in most plans. So the benefits of a Roth 401k, including that as a deferral possibility, are really the growth on those 401k contributions that are made on a Roth basis is tax-free. A lot of the appeal is for employees who are in a low tax bracket currently, but are kind of, have a crystal ball or anticipate being in a higher tax bracket at retirement. So typically a lot of younger people fall into that category. And then, just for anyone, it offers the ability to not only, you have different investment funds in the plan, so you can diversify from that perspective, but this addition of having 401k deferrals on both a pre-tax and a post-tax basis allows a different type of diversity. So it's the diversity of tax treatment of the employee's contributions going into the plan. A lot of people kind of get the terminology between a Roth 401k and a Roth IRA kind of jumbled up a little bit. So just a really quick comparison of the two. In order to be able to contribute to a Roth IRA, the IRS puts into place income restrictions. So generally, I think for 2021, there is, for someone who files either as a single taxpayer or head of household, there is, and I have kind of a sliding scale, 125,000 to 140,000 is the corridor essentially of compensation where the limits are applied for a Roth IRA. If you're married filing jointly, then that corridor is 198 to 208. And the corridor is there because the upper limit, you're shut out completely. You cannot make any contributions to a Roth IRA. In the interim between, for example, 198 and 208, there's a calculation where the contribution is scaled back. You can still make a contribution, but just not to the full level. In contrast to that, a Roth deferral feature in a 401k plan, the contribution levels are higher. They are essentially, they're the same as what any 401k deferral limit is. It's the 19,500 plus 6,500 if you're over age 50. That deferral limit applies if the employee decides to make some deferrals on a Roth basis, some on a pre-tax basis. The limit applies to their total contribution. So this essentially, I'll give everybody a second to take a look at this, just a comparison of Roth 401k plan or Roth 401k feature to traditional pre-tax 401k contributions features. In bold are really where the differences are. There's after tax on a Roth basis. So again, with the tax diversity of the type of deferrals that the participant is permitted to make, traditional 401k contributions are made on a pre-tax basis. There's no income limitation with respect to participating in a 401k plan on either basis. You can make Roth deferrals, you can make traditional 401k deferrals. It does not matter what your income is. As I said a minute ago, the deferral limit is the same for both, and it is inclusive of both. If someone wants to do half and half, the overall limit is still 19,500 plus the catch-up amount. On a Roth 401k feature, the contrast here with respect to withdrawals of contributions and the investment growth on those contributions. On a Roth account, they're not taxed, provided the withdrawal is qualified, and I use that in quotes. The IRS considers a qualified withdrawal if the participant is at least age 59 and a half and the account has been held for at least 5 years. Contrast to that, on a 401k, a traditional 401k withdrawal, it's all taxable. It has all been growing on a pre-tax basis, so anytime a distribution is taken, that distribution is taxed at federal and, in most cases, state tax rates. The required minimum distribution rules for age 70 and a half or now age 72 are the same with respect to whether the deferrals were made on a Roth basis or a traditional pre-tax basis. So just a couple of things to consider, going into it with your eyes open. Really, it is a very simple amendment to make to the plan, just adding the ability. It's literally checking a few boxes to allow for 401k contributions to be made on a Roth basis to the plan. The important thing is within the payroll system to ensure that the additional money source is set up correctly to track those deferrals separately, whether they're made on a Roth basis or a pre-tax basis, which ultimately get reported on the employee's W-2 at the end of the year. So it's important that they're withheld properly so they can be reported properly at year end for tax purposes. You can allow within the plan, an employee, like I said before, can elect to make contributions on either a pre-tax traditional 401k basis or a Roth 401k basis or both. However, if we've been talking about testing requirements and just want to point out that there is one other similarity between traditional 401k and Roth 401k contributions. If your plan is not a safe harbor, it's subject to ADP testing as well. So if your plan now has traditional 401k contributions and Roth 401k contributions, and someone elects to do both, those amounts are added together when calculating that employee's average deferral percentage for testing purposes. If your plan has a match on deferrals, whether it's a safe harbor or whether it's a traditional match, that match is applied to Roth 401k deferrals just like pre-tax 401k deferrals. So if you match the first 4% of compensation and someone is deferring a total of 10% of compensation, and that's inclusive of Roth 401k deferrals, then that match applies to them as well. One other kind of offshoot of having Roth contributions, which I'll get into a little bit more on the next slide, is something that's referred to as either Roth conversions or in-plan Roth rollovers. Roth contributions, as I said earlier, have been around since 2006, but since 2010, there is an additional feature that can be added to a plan that already allows Roth 401k deferrals that is referred to as a Roth conversion. And again, employee education with respect to any plan feature or plan changes is key. Communicating the difference between contributing on a 401k basis, whether Roth or pre-tax, is important. And most record keepers have employee education material that do a good job of this, but it is important to have that out there for employees so that they know what they're getting into. Okay, with respect to Roth 401k conversions, this essentially allows someone who's been contributing just on a pre-tax basis to, if they have a situation where and the plan amendment will specify this, they can decide if there is an in-service distribution criteria specified in the plan. It's essentially like the participant is taking a distribution, quote unquote, of their pre-tax monies, which the sources would be identified in the plan document. They're taking a distribution, and I if you could see my air quotes, that's what I would be doing. And they're rolling it over. It's not leaving the plan. They're rolling it over into a Roth rollover account within the plan. So they are taking the tax hit on that quote unquote distribution now, but retaining the monies in the plan. Just because a plan has Roth 401k deferrals allowed, it does not mean that that same plan has to permit for in-plan Roth conversions. It is somewhat of a specialized animal, and absolutely can be handled by your record keeper and Nova as your TPA, but just wanted to point out that it's not required if your plan offers Roth. If you do decide that you want to allow this type of feature in your plan, you do have to allow Roth 401k contributions first. So that does have to be in place before you can allow Roth 401k rollovers. When, like I said, when the distribution occurs, the participant is immediately eligible or immediately subject to tax withholding on that pre-tax amount that they are rolling over as and essentially changing the nature of it from pre-tax to Roth. However, the plan is not required to do that tax withholding at the point of the conversion, unlike other other distributions that occur. The plan has to be amended to allow for that. As I said, it's not something that you have to include, but if you do want to include it, then the plan has to be amended. Need to speed it up a little bit. Okay, one other feature that we see a lot of is automatic enrollment. So essentially, an employee is notified that, hey, if you don't say anything, if we don't hear from you, we're going to automatically enroll you in the 401k plan. Really, the primary reason for this is that employers want to improve 401k non-discrimination testing results. That has been the push from the get-go, essentially, when automatic enrollment was first allowed. However, there are big talks and upcoming legislation that would potentially, not quite sure how this is going to fare, would potentially make automatic enrollment required for all plans. There's 3 different types. A traditional automatic contribution arrangement only can apply to new hires. An eligible automatic contribution arrangement is something that can only be amended prospectively. So if you decide you want to do it, you can't do it now. It has to be effective for the beginning of the next plan year. The benefits of that are that you get an additional time frame to do your non-discrimination testing refunds if your plan is subject to non-discrimination testing and you fail, as opposed to March 15th for a calendar year plan, you get up until June 30th. And it has to apply to all employees. So in this case, you can't just pick and choose who it's going to apply to. And then the last is a sort of a safe harbor hybrid of an automatic contribution plan, a qualified automatic contribution arrangement. This is a safe harbor plan, so you don't have to do non-discrimination testing. And unlike most safe harbor plans where the contribution is 100% vested, there is a 2-year cliff vesting allowed in a QACA safe harbor. Auto-escalation, so on an annual basis, is required in a QACA safe harbor unless the default enrollment rate is 6%. So the benefits of automatic enrollment are, that you get more people into the plan. You're banking on inertia, essentially, people not letting you know that they don't want to contribute, and you get them into the plan, and many of them don't do anything other than that. On the flip side, you get more people into the plan, you've got increased matching contributions if your plan is structured that way. And I will mention additional administrative work. This is an area, certainly not trying to dissuade anyone, it is an area where we see significant errors, where it wasn't handled properly. And as a result, there are IRS required corrections if you have people who should have been auto-enrolled and weren't. So if it is something that is part of your plan or you want it to be part of your plan, it is crucial, I can't stress this enough, that on the front end, you ensure that it's going to be administered properly. That's typically best handled by your record keeper as opposed to in-house, but still, it's very crucial to understand what their process is and what's required from you as the plan sponsor so that their process, so that their administration can be handled properly. You don't have to, in all other than QACA plans, you don't have to include automatic escalation. You can just automatically enroll someone at a rate and then leave it at that. Or you can include an escalation where on an annual basis, after someone is automatically enrolled, their contribution rate ratchets up by 1%, up to whatever maximum you set in the plan. Some employers like this as just kind of a gentle nudge to get people saving closer to what they actually need to be saving at to be ready for retirement. You can, like I said, you can include it in any of the 3 different automatic enrollment structures, but if the plan is a QACA, the qualified safe harbor version of the automatic enrollment plan, there are additional requirements. Like I said, unless you're setting the initial rate at 6%, if it's a lower rate, then you have that additional automatic escalation that is required. And the Secure Act has actually increased the required cap from 10%, which it was, up to 15%. Okay, the last thing that I'm going to run through very quickly is, again, I think most plans do provide for in-service withdrawals. Not all provide for loans, but why consider this? In some cases, just the ability, just having a participant realize that there is the ability to get at their money while they're still working is enough to encourage them to participate in the plan. Not that they're necessarily going to ever take advantage of it, but just the possibility that that it's there if they need it. So a loan in a 401k plan has to be repaid. It's repaid to the participant's account. They take it out of their account. It's repaid to them. Generally, the maximum time period is over 5 years. Required interest rate, I really don't see anything other than prime plus 2%. It has to be reasonable, and that has been deemed to be reasonable. The deductions for the loan repayment amounts have to be made via payroll. You can restrict the available money types. So, you have various sources of money within the plan. You can restrict loans from, typically we see it's available from all, but some plan sponsors limit it to only 1 or 2 sources. And typically loans are allowed for any reason. However, there are plan sponsors who do limit loans only financial hardship reasons, which leads me to what is a hardship distribution. As a distribution as opposed to a loan, it doesn't have to be repaid. It's taken from the participant's account. It is taxable when it's taken. And if the participant is under age 59 and a half, it's subject to the 10% early withdrawal penalty. By definition, a hardship distribution is only in the event of an immediate and heavy financial need. And on the next slide, I'll look at what that means. That is criteria that's set by the IRS. So there, when you have this type of feature in a plan, you get some participants saying, well, it's my money, I want to take it. The IRS sets the reason. It's not something that is by design, it's legislated. How you can, however, restrict which, like loans, which money sources are available for hardship. So these are the IRS deemed reasons that constitute an immediate and heavy financial need. If you're taking a hardship distribution for medical expenses, purchase of a primary residence, not including mortgage payments, post-secondary tuition and fees, to prevent eviction from a principal residence, to pay funeral expenses, or to pay for expenses that are related to damage on a principal residence in a disaster or a federally declared disaster area. Those are the 6 reasons, nothing other than that. There are other considerations, like there are typically processing fees inherent in setting up a loan or processing a hardship distribution. Those are typically paid by the participant. They're netted from the distribution that the participant gets. There is additional administrative work. In most cases, that can be handled largely by your record keeper and or Nova's distributions team. But if you do payroll in-house, for example, and you have a loan that a participant has taken out, your payroll department has to get those deductions set up correctly. And then employee requests. You have this type of option in the plan, you're going to have to entertain employee questions and requests as well. So that, sorry for speeding it up at the end, that is it for my section of the presentation, and I'm going to turn it over to Jason.
Thank you, Carrie. Good information on that first half, lots of detail, lots of things that I'm sure our attendees are interested in. I'm hearing from Jasmine that we're getting a lot of questions and probably more than we're going to be able to get to before our allotted time is up. But we typically, in that instance, we will send out responses to those questions at a later time. So keep the questions coming, you will get an answer on them. So digging into the second half of our presentation here today, we want to talk a little bit about some Secure Act changes. The first one is talking about a new type of in-service withdrawal that was allowed in qualified plans. And it is essentially, it's kind of referred to as a baby distribution, right? So that's a distribution that is allowed to help new parents, whether through birth or adoption, by allowing them to take money out of their plan. They can take up to $5,000 per birth or adoption. It's a per child thing, so it'd be $10,000, for example, if your person had twins. It does require a plan amendment to allow this distribution type. The Secure Act also mentions that there is repayment options, so the participant could repay these funds to the plan if they so choose. However, we have not received any additional guidance from the IRS yet about how this will actually function. So while this is technically available, very few retirement plans, and I don't believe any Nova clients are signed up for this particular type of distribution. Very few of our record keeper partners have the technology in place in order to accommodate this at this time. And really everyone's waiting for additional guidance from the IRS before we can really implement these provisions. But it is useful to be aware of because there have been participants that have asked some of our plan sponsors about this distribution type specifically. Moving right along, the other one that's going to be a big deal, and there will be a lot of additional webinars and a lot of discussion and a lot of communications coming around this, is long-term part-time employees. If you are a plan sponsor who currently excludes part-time, temporary, or seasonal employees that did not work 1,000 hours in a plan year, then you definitely want to be paying attention to this rule and the guidance that's going to be coming out around it. Effective 1/1/21, so this is already in effect. If an employee completes 3 consecutive years with at least 500 hours of service, they must be allowed to contribute to the plan. So they start measuring this year, so the earliest year that one of these folks could be allowed to participate in the plan is January 1st of 2024. But you do have to start record keeping for this in 2021. Now, what does it mean? They're allowed to contribute, but they are excluded from any employer contributions. They are excluded from your ADP and ACP testing, so they won't hurt your testing by having them included. And then if you decide to provide them with an employer contribution, then their vesting is different than your rank and file employees also. I think that provision is going to dissuade a lot of plan sponsors from covering these long-term part-time employees with employer contributions, but time will tell. If you have one of these long-term part-time employees who ends up working 1,000 hours in a plan year, then they have to be treated just like any other employee. So they would have to be eligible for employer contributions, etc. So there's going to, again, this thing doesn't really take effect until 2024. So we expect a lot more guidance to come before it becomes effective. But we encourage all of our plan sponsors, if you have these part-time, seasonal, temporary employees, to start tracking hours, not just for the 1,000 threshold, but for the 500-hour threshold. Because when 2024 comes and we ask you if this person has worked more than 500 hours for the last 3 years, you're going to want to have that information handy. Okay. There we go. Okay, so the other change, whoops, went a little bit too far there. So the other change that came up through the Secure Act was talking about required minimum distributions. These used to be the 70.5 withdrawals, but the Secure Act has changed them to 72. So no longer do you have to be age 70.5 to start taking a required minimum distribution. Now it is age 72. No other rules around required minimum distributions changed as a result of this. It was just the age that was adjusted. Okay, so it's for participants who reach age 72 after December 31st of 2019. Okay, so if somebody turned 70.5, you know, on 12/31/18, and they started taking their required minimum distributions, they can't stop until they turn 72. They would have to continue. Okay, so only people who reached age 72 after 12/31/19 are subject to these new rules. Anyone who turned 70.5 prior to that date would still be subject to the old required minimum distribution rules. Okay. And as just as a note, this is our first year back to required minimum distributions. As you remember, the CARES Act last year suspended all required minimum distributions for 2020. So this is a first year back with these required minimum distributions after a quick break. Another item with the Secure Act that we just got guidance on this week, actually, so this is hot off the presses. The Secure Act allows people to start a new 401k plan up until their tax return due date plus any applicable extensions. It used to be that you had to start a plan before the end of the plan year that you wanted to start. So the old rule, if you wanted to start a plan for 2021, you had to start it before December 31st of 2021, okay? Under the new rule, you have up until your tax return due date plus extensions in 2022 to set up a plan for 2021. Now, the only benefit of that would be for a plan who wants to make an employer profit sharing contribution, but for the plans that are like that, or plan sponsors that have a windfall in 2021 and their accountant says, hey, we'd love to reduce your taxes some, can you make a contribution to a qualified plan? This is a rule released by the IRS that will allow them to do so. Now, for some of the more astute folks out there, you may think, well, if you are able to start a plan after the Form 5500 due date is passed, how does that work? Well, the IRS, that's what they came out with this week. They said that a plan that was started in 2021 for the 2020 plan year does not need to file a Form 5500 for 2020. Instead, the 2021 Form 5500 is going to have a special box saying that this plan was adopted after the end of the plan year, so that the IRS does not send a nastygram to that plan sponsor asking them where their first Form 5500 is. So this is big news. It's going to be a big deal. Probably not so much for those of you out there that already have a 401k plan, but if you're a financial advisor who's working with your clients or a CPA, this presents a lot of planning opportunities. And if you know who your Nova salesperson is and you have a potential live one on this, get with them because they're happy to talk you through how to make this happen. Okay, you may remember in the CARES Act last year that people were allowed to take essentially a COVID withdrawal. They could take up to $100,000 out of the plan, and they were able to do it with really little certification, right? The important part about this is that these distributions can be repaid to the plan within 3 years. So the participant could be coming to you. We expect this to be a very rare occurrence, but you could have a participant that comes to you and says, I would like to repay some or all of my CARES distribution, okay? They can do that for up to 3 years. So they'll have until 2023 to complete that repayment, okay? Also, their taxes due are spread ratably over those 3 years. So there's a lot of stuff that's still going on with regards to these distributions. You cannot take these distributions any longer. So December 31st, 2020 was the last time it could happen. But because we have this kind of 3-year window where people could, in theory, be returning money to the plan, we want to make sure we're mentioning it. These distributions were optional in our plans, but most NOVA clients elected to allow these withdrawals. So, again, just be aware because it likely applied to you. Okay, other things that we can talk about. Carrie kind of mentioned some of these things earlier in the slideshow, but just in a little bit more detail in our last few minutes. If you make a match or an employer contribution, you are not necessarily locked into the type of contribution that you want to make, okay? So if you want to reduce or increase your match contribution, change your formula, anything like that, those are generally speaking things that you can do mid-year. So definitely get with your NOVA account manager and we can talk to you about the possible repercussions of that, impacts on testing, additional cost outlays, etc., if that is something that is interesting to you. We have a lot of flexibility with employer non-elective contributions. So if you have particular people that you are looking to reward or specifically benefit in your 401k plan, talk to us about what's called a new comparability allocation, and we can target the people that you want in many cases to maximize their benefits. Okay. And then we also have, if you have a particularly good year and you expect those years to continue, we also have the capability and expertise to talk to you about things like a cash balance plan, which is a type of defined benefit plan. We can also talk to you about a 457B Top Hat plan, which is a plan that is specifically designed just to benefit a certain small group of highly compensated employees. So all of these are options that you can come to your NOVA account manager to talk about if they are at all interesting, and we can guide you on whether it's a good move for your company and how to make it happen. Okay, plan amendments. There's a lot of things going on with plan amendments right now. We are currently restating plan documents onto the Cycle 3, sometimes referred to as the tri-cycle IRS approved document. NOVA, for example, is sending out restated plan documents onto this new pre-approved document to about 400 of our clients per month, okay? So there is a lot of these that are going on at this time. If you want to make any changes to your plan, this is a great time to talk to your NOVA account manager because we can roll those amendments in with updating your plan document to this new IRS pre-approved document, okay? That allows us to minimize cost for you and helps us get your plan onto the new document as quickly as possible. So there are a couple of things around the Secure Act and the CARES Act in particular, talking about that adoption distribution, for example, that the plan does have to be amended to reflect those provisions. Congress allowed us to make that amendment up until December 31st, 2022. And most document providers out there do not have an amendment for that yet because everybody's waiting for model language from the IRS on those amendments. So at some point, do not be surprised by a communication from NOVA saying we have an amendment to your plan to comply with the Secure Act and the CARES Act. Yes, those acts were passed 2 years ago, but because of the way that the deadlines work with the IRS and these rules, we have until the end of next year to get those amendments put in place. If you do want to do those policies and procedures, you can do them in good faith or comply operationally with them before the amendment takes place. Okay. It is also worth mentioning that with some of these amendments, a notification to your plan participants may be required. Okay. The end of the year is generally a very busy time for plan amendments because everyone's trying to get their document changes made prior to January 1st. So if you do have information that you want to change about your plan, get with your NOVA account manager, preferably before October 1st, to make it more likely that we're able to get that information and that amendment executed before the end of the year. Okay, I'm going to skip over the investment strategy versus inventory discussion. Okay. From fiduciary risk and investments, you see a lot of lawsuits out there about people improperly monitoring or not getting good expense ratios on their funds. One of the best ways you can protect yourself as a plan fiduciary is establish an investment policy for the plan. If you have a financial advisor on the plan, they are going to be a great ally in helping you get this put together. You want to be involved in selecting the plan investments. Again, you might be outsourcing this to somebody else, but you should be having meetings with that person to make sure that they are explaining to you why they're keeping or changing funds and why not. And then you want to make sure that you're monitoring those experts that you've engaged. Okay. All right. Nova has a whole bunch of additional webinars that are available at this link. And this link I'm sure Jasmine's going to send out as well. And then for a last reminder on CPA credit, there's going to be an evaluation form that's going to be sent. You will have to return that, and then you'll receive your CE certification within 1 week. Jasmine, we are right at time, so I'm going to turn it over to you for housekeeping.
Thanks, Jason. So it looks like we did run out of time for questions. So if you did submit a question, we will get to you by the end of next week with an answer on that via email. So just be on the lookout for that. Thank you to everybody for joining us today. And thank you, Jason and Carrie, for the great information. Please note there will be a survey that will pop up right after the webinar ends for you to complete if you need that Texas CPA or ASPA CE. So be on the lookout for that to complete. And the certificates will be sent out in 1 week. And just a reminder, the recording of this webinar will be made available on our Nova YouTube channel by the end of next week as well. If you do have any other questions, please reach out to your designated account manager and they will be happy to assist you. And for any other questions, please email us at webinars@nova401k.com. We hope everyone has a great day.